past few years, the world of investing has seen a paradigm shift in values driving investment. The idea of responsible investment is garnering a lot of attention, and COVID-19 gripping the world has only re-emphasized the importance of sustainability of resources in our lives. Conversations around climate change, degradation of natural resources are gaining momentum, forcing us to think whether advancement at the cost of survival is endurable. There's an evident shift in investor sentiment as well, which you can clearly see in the surge in ESG investing, socially responsible investing, also called as SRI, and impact investing. Now, simply put, ESG investing is a strategy you can use to put your money to work with companies which strive to make the world a better place. In impact investing, it essentially aims to maximize societal reach in a quantified manner. And in socially responsible investing, investors map their portfolio to their beliefs and values using positive or negative screens and include or exclude companies based on that. ESG is the bedrock of SRI if you look at it, and it stands on three pillars: environment, social, and governance, which stand for the word ESG, in case I didn't mention that earlier. Let's talk about the three pillars of ESG investing. First is environment, which essentially involves recognizing profound impact of economic activity on the environment. Several companies are proactively adopting measures that can reduce emissions and create solutions to mitigate the negative impact of business activity on the environment. S stands for social. This component of ESG mainly refers to a company's social code and its consequent impact on the various stakeholders in its ecosystem, including employees, customers, and even suppliers. Third is corporate governance. The people that helm a company and the governance practices followed play a significant role in steering a company towards positive outcomes. Generally, companies that follow good corporate governance practices are well aligned with shareholder objectives and also can generate value for shareholders. Acting as responsible citizens, investors are now evaluating target companies not only based on financial parameters but also on the basis of certain non-financial parameters. Investors are increasingly applying these non-financial factors as part of their analysis process to identify material risks and growth opportunities. For the non-financial parameters, ESG usually is considered a good starting point. While companies are shortlisted based on traditional financial metrics and future growth expectations, they are also filtered based on predetermined ESG attributes. Now, this involves using a sustainability lens to identify investable companies. Through this approach, investors aim to generate long-term growth while proactively taking steps to limit the impact of unsustainable practices on the society and the environment at large. And research increasingly shows that this investing method can reduce portfolio risk, generate competitive investment returns, and also help individuals and investors feel good about the stocks that they own. Though the idea of investing on ESG parameters is at a nascent stage in India, globally, it's a well-entrenched concept in the field of investing. As per EPFR's recent report, SRI and ESG investments recorded inflows of $168.7 billion in 2020, up from $63.3 billion in 2019. According to a Morgan Stanley survey conducted in 2019, 85% of retail investors are interested in sustainable investing. Earlier, retail investors, distributors of financial products, or financial advisors focused on returns only. But now, society wants to associate with businesses that are more responsible towards sustainability. This is already visible in the global lending and investing practices, and India is likely to catch up quite soon. ESG investing in India is at a promising, though very nascent stage. The NSE has already launched 3 ESG indices: Nifty 100 ESG, Nifty 100 Enhanced ESG, and Nifty 100 ESG Sector Leaders. If you look at it, MSCI India ESG Leaders Index outperformed its respective benchmark by 61% over FY11 to FY21 period. In fact, in India, the Nifty 100 ESG Index has outperformed Nifty 50 by delivering superior 5-year returns in 2020. It's important to note that there are no uniform standards for ESG yet in India, and fund houses have adopted their own methods to determine which stocks make the ESG cut. Now, if you're interested in ESG investing, what to keep in mind? Firstly, verify that the fund offered is following ESG principles rather than using it as a marketing ploy. You can do that by checking its portfolio thoroughly. Secondly, what is the methodology? What may be ESG to the fund house may not be ESG for you. Fund houses usually make the selection criteria available on their website, so best to look there. Alternatively, you can construct your own ESG portfolio. According to experts, capital goods, financials, healthcare services, IT and pharma are best placed within the ESG segment. Consumer staples and telecommunication services with low risk can also be looked at. But of course, portfolio investing and creation of ESG portfolio will require you to devote significant time and energy towards researching these companies. While ESG offers one strategy for aligning your investments with your values, it's not the only approach. Ensuring that your investment choices are aligned with your priorities should be of prime importance.